What's up, everybody? Welcome to the life cycle of a trade, the series where we break down the thought process behind trade entry, trade management, and closing order. In this video, we are going to cover an iron condor. Ethereum has had an absolutely massive rally here. We are trading on ETH itself on spot around 4,600 here, 4626 to be exact. There is a way to trade it in equity ETF market land here. ETH A is the most liquid of the bunch of the ETFs, much like the Bitcoin ETF, which is IBIT. Very good liquidity here. You can see 8 million shares and change here traded today already. The options themselves are not the most liquid, but they are getting better. You can see there are some strikes that have a pretty decent open interest as well as volume coming in. You can see there's tons of call skew. So when we go to the trade page and we just go to Delta, let's say the 21 Delta here, 47 on the upside in the October expiration. On the downside, it's going to be at 29. So you can see our skew 6 points to the downside, and then to the upside, we have about 12 points. So you have almost 2 times as much premium on the upside versus the downside. And we can actually see that here on the expiration curve. So you can see this blue expiration curve up here, much wider to the upside. That's where the upside skew is. You can see it here. The drop off on the downside is much, much steeper. So we're going to put on a position here. I'm thinking we play this just as a premium play. We have an IV rank of 100. It's actually gone above 100, which means it's one of the highest, if not the highest, volatility that we've had in ETH A to date. So we're going to put on a wide iron condor here. You can see when we put on a strangle here, we use about $2,000 in buying power. It's too big of a position for this account, so we're going to do something that's about a 10-point wide iron condor here. So I like to go to somewhere around the 20, 25-ish delta. I'm going to go to the 25 here on the downside. It's a nice round number, lots of open interest there, so a little bit better liquidity than some of the other strikes here. We're going to go 10 points wide here. You got to be careful with this pricing because these markets are a little bit wide. When we route this order, we're going to route this above the mid price and see if we get filled from there. On the upside, we're going to do around a 25 delta, so we'll say the 45 strike here. We'll go to the 54 because there is no 55 here. So we're actually going to be 9 points wide on the upside and then 10 points wide on the downside. You can see we're doing this for a little under 1/3 the width of strikes, but we are, right at or outside the expected move here, especially on the upside because of this upside skew that we have. So again, we're going to route this order well above the mid price and work our way down from there because we do have some wide bid-ask spreads, especially on this put on the downside. Might even move it. No, we're going to keep that put. So we're going to start this, let's say 250, and see if we get filled from there. And we'll just cancel and replace it here. You're probably going to have to do this in nickels, which is 5-cent increments. No fill there. Try 240. 233. All right, so we got filled at 233 on this ETH A iron fly / wide iron condor here because of how much volatility there is. It will act kind of like an iron fly here. We're going to look for 50 to $100 out of this trade, hopefully in the next couple weeks. So we've been in this trade for about a little under 3 weeks, or just about 3 weeks here, about 18 or so days, calendar days. So we've had this trade on. It's lost about half its value, which is great, and we're going to be closing this trade out profitably, which is good position. But I wanted to really highlight the couple things that we play for with these iron condors. So the first thing we're going to look at is the price. So the stock, or the ETF I should say, has moved about $1, which is about 2-3 percentage points here, which is not a small move, but is well inside what the expected move would have been given implied volatility. So we had an inside move. We also, when we look at IV rank, you can see the IV rank when we put the trade on was 94. We're now sitting at a 57, which tells you volatility has contracted significantly here. And you could see that when you look at the IV index. When we placed the trade, it was at about 79. It's now at 73. So not only did you get the sideways movement in the ETF here, but you also got a huge vol contraction along with time decay. And all of that is going to contribute to the profitability of this position. Even going back to the chart, you could see when we put this trade on, it was on the 27th. So we did it right around here. We've had basically, a full kind of round trip throughout that period of time, but it's been choppy. It's really been about the time decay and the volatility contraction here. So we're going to be closing this one out and taking some profits. The first thing I look for is just to make sure that the options have bids on them. So, when you have a bid, that's a price that you would sell at, somewhere between the bid and the ask. You can see a lot of the value really coming out of this call side. This product has a ton of call skew, and so that call side, and we can even look at that here just to give you an idea. Look at the 45 strike call, you right click and you go to view option on chart. We sold this at $1.41. It's now at 41 cents. So we made pretty much all of the money back, all the money on the trade, the profitability on the trade coming via that short call. We can even look at the put here. So this put, we sold it at $1.76. It's currently marked at 98 cents. So we made about 70 some odd cents on the short put and about $1 on the short call, even though they were pretty much equal width away from the stock price, so the ETF price. So the difference in that, in terms of the profitability, is coming from the decay in those long options, which is, a way to reduce buying power, obviously defines the risk as well. So, there's always a gimme and a gotcha to anything. So when you're trading an iron condor, you're going to give up some of the profitability versus a naked position, because you have to define the risk and reduce the amount of capital that you're using. So we're going to see if we can get filled here on this trade. Let's try 122. I have a feeling we'll have to go a little bit higher. Oh, or we won't. We're going to get 122 on the dot. That gives us $111 profit here on this iron condor. The perfect example of time decay, a volatility contraction. Those are and a sideways move in the stock. Those are exactly what we were playing for, and we got them all. Good trade for the Johnnies here.